Hi, I would like to formally introduce myself. I am Krisha N. A. Tampos, a grade 11 student from Hernandez. The 5 types of major accounts is number 1, asset accounts, number 2, liability accounts, number 3, equity accounts, number 4, revenue accounts, and lastly, expense accounts. Asset account, where you record things that the business owns. Liability accounts, where you record debts that the business owes. Equity accounts, where you record the funds introduced into the business and drawings by the owners. Revenue accounts, where you record money received by the business. Expense accounts, where you record money paid by the business. Current assets are those that you can convert into cash within 1 year, such as short-term investments and accounts receivable. Non-current assets are longer-term assets with full value that you cannot recognize until after 1 year, such as property and machinery. Current liabilities are the obligations due for payment or settlement within the next 12 months. Non-current liabilities are long-term obligations, including debts of the business which are not due for payment within the next financial year. Current liabilities, obligations that will be settled by current assets or by the creation of new current liabilities. Accounts payable are due within 30 days and are paid within 30 days, but do often run past 30 days or 60 days in some situations. The laws regarding late payment and claims for unpaid accounts payable is related to the issue of accounts payable. Non-current liabilities, although payment may not be due within a year, it's important a business doesn't overlook its non-current liabilities. It may still have to make payments toward a non-current liability, like a loan during the year. Non-current liability are an important part of a cash flow forecast. By comparing non-current liability to cash flow, a business can see whether it has the ability to pay as future debts and grow.
An account title is the unique name assigned to an account in the accounting system.
An account title is essential when the accounting staff needs to identify an account, since the title conveys the purpose of the account. The other unique identifier, the numeric account code, may incorporate some identification logic, but is much more difficult to associate with a specific account. Without an account title, the possibility of making an incorrect entry into the wrong account would be much higher. A chart of accounts, or COA, is a list of the accounts you must use to record financial transactions. In your general ledger, it helps you keep track of where money comes and goes. A chart of accounts is integral to your bookkeeping, accounting, financial, and reporting. They're like a map that helps you categorize your transactions correctly and group similar accounts together for reporting.
The chart of accounts is divided into 5, which is the
asset account, where you record things that the business owns. Liability accounts, where you record debts that the business owes. Equity accounts, where you record the funds introduced into the business and drawings by the owners. Revenue accounts, where you record money received by the business. Expense accounts, where you record money paid by the business. The chart of accounts is organized under 5 main account types, while the 5 main accounts at the top stay the same. The accounts that sit underneath can be customized to suit your business. In financial accounting, a balance sheet, also known as statement of financial position or statement of financial condition. It is a summary of the financial balances of an individual or organization, whether it be a sole proprietorship, a business partnership, a corporation, private limited company, or other organization, such as government or non-for-profit entity. Assets, Liabilities and ownership equity are listed as of a specific date, such as the end of its financial year. A balance sheet is often described as a snapshot of a company's financial condition. The statement of comprehensive income contains those revenue and expenses items that have not yet been realized. It accompanies an organization's income statement and is intended to present a more complete picture of the financial results of a business. It is typically presented after the income statement within the financial statement package, and sometimes on the same page as the income statement. A smaller business with a relatively simple operations may not have engaged in any of the transactions that normally appear on a statement of comprehensive income. If so, they do not need to produce the statement.